Hello everyone, welcome back to my channel. So in this video we are going to continue to describe our advanced option strategies that traders can use among several others in their arsenal to cope with different market conditions, different objectives, and of course different levels of risk tolerance and different levels of budgets. And so in this video we are going to talk about only another one of these strategies, which is a collar, and this will make videos a little bit shorter and a little bit more digestible for all of you to understand and be able to accumulate this knowledge in a more paused and phased way. And so the collar is a strategy which basically intended to provide for the most part protection for the trader against high volatility events. And so this strategy is also widely known because if you know the history of the business career of the American billionaire Mark Cuban, which is mostly popular because of his participation in the Shark Tank program, and so which of course it's US and it was broadcast in multiple countries. And to give you a bit of a background story, this strategy became very popular because of the way Mark Cuban used this strategy to protect his investment. Basically, he sold one of his companies, broadcast.com, back in 1999 to Yahoo, and he received in return a large amount of shares of Yahoo stock in return for selling the company. And so remember that in 1999 the dot-com boom was ongoing and internet companies were being valued at extremely high levels, and at the time Mr. Cuban could not sell his stock immediately after receiving those shares upon the sale, and so he was forced to keep them for a while. And he knew that because valuations were so high, there was a risk that a significantly large correction could be on the cards, could be on the way. And so he did not want to be caught out by this situation if it happens, and if that happened, then no protection was taken. He could basically lose all of his investment, basically, because this was, of course, it's not an investment, but it's exposure. The shares could have lost significant amount of value, and of course the proceeds from the sale of his company would have gone away. And so basically he through an investment bank he decided to use this option strategy to protect the value of the shares, Yahoo shares that he received. And he did this at a time in which, and of course for a period of time in which something could happen. And eventually when the dot-com bubble bursted, he was already protected, and so he was able to protect his fortune. At the time it was more than 1 billion with a B, $1 billion worth of shares, and so he was able to protect his basically his fortune against the meltdown of the stock market by the time the dot-com bubble burst already in 2000. But I'm going to explain to you this strategy, and we want to be able to see the different mechanics of the strategy and how the strategy can be used to protect an investment. And you can, as you can see right here, you can adjust your risk exposure according to your risk tolerance. Of course, if you are willing to incur in a higher risk, you will have as a reward a lower cost of implementation of the strategy. But if you want to really hedge as much as you can your exposure and reduce the potential losses to the minimum possible, of course there's going to be a higher cost. But if you are willing to incur some risk, you can do this protection at virtually at a zero cost. But I'm going to show you an example. If we pull up the option chain here at Distillode, and let's see right here. So basically the strategy, and I'm going to use an example similar to what Mr. Cuban did, was because let's just assume that we have a significant amount of Distillode shares. We have it at this point, but let's just say that we want to hedge against any significantly large periods of volatility, but we don't want to have any sort of cost in protecting ourselves against this high volatility event that may come in the future. And so what we need to do is to look here at the puts, at the option chain on the put side, and we see that we have several options here available, all right, with several costs. And so if we try to match the cost of buying a put, which are right here, with the value that we would receive by selling a call, all right, we'll be able to see here that, for example, we have here a put option which we can buy, and it's going to cost us 40 cents a dollar, all right, and the strike price is at 59. And we see here that there is a call that we can sell also at 40 cents of dollar. And so let's just say, for example, I want to buy 1,000 puts. So pretending that I have 100,000 shares of Distillode, and I want to also sell 1,000 calls. As you can see right here, I would not pay anything to implement this strategy. All right, this is called a risk reversal, but this has the same thing as a collar. And so as you can see by the pattern that it is in here, if the stock goes below the strike price of 59, we'll be able to sell, or have the option to sell, our entire holding for 59. But if it also goes above 69, we will be forced for sure to sell the stock we have at 69. But by having this, we are, of course, we are capping our upside, but we are protecting for free any downside below the 59. And so by having this, of course, this is a quite wide range of values, because between 59 and 69 there is some potential volatility here, and we are not protected. As you can see, the price today as the market is closed is 63.88, and so if the stock goes all the way up until 60 or 59 and a half, we are not protected. But that is the additional risk exposure we have for not wanting to pay anything for this particular strategy. And let's just say, for example, that now I am a very risk averse trader and I don't want to lose almost anything on this trade, and I'm willing to pay some premium to be ensured that even against a small loss, I will be able to protect myself. And so, for example, what we can do is, instead of using a $59 strike price for a put, we can use, for example, and since the stock is finished trading yesterday at 63.88, we can use, for example, a 63 here. It's going to cost us $1.80 per contract per share, And we see here that, for example, by remember that we are the stock is trading at 63.88. By capping virtually all of our upside, and so as a very small a very small upside will cause us to sell this stock. So our upside is fully capped almost entirely by 12 cents. It only is not capped, and so by capping all of our potential upside, we are able to have this very tight collar, as you can see right here. And so the stock will we are protected if the stock goes below 63, as you can see right here. But this comes at the expense of we will not gain anything else on this stock. Of course, we'll still receive a small credit of 10 cents because this call is more expensive than this put. But if we decide, well, I want to be protected, all right, against even a very small downside, but I don't want to be that limited in terms of my potential upside. All right, in that case, we can open our upside a little bit more. We can go, for example, for this 67, the strike price. But of course, in that case, we're gonna have to pay $1 per each contract, you see. And so this is the difference. And so by incurring in this cost, we are a little bit more open to have more upside and still getting some strong protection. But this is the trade-off. And yeah, this strategy worked like a charm for Mr. Cuban, because he decided to use, to the best of my knowledge, a collar that allow him not to pay almost anything for this strategy. So he had to use quite a large band, or quite a large range in which the stock would be unprotected, but still it was enough for him to keep most of his money when the bubble burst, and he was able to exercise his puts to keep his fortune on his side, let's just say. And so yeah, this is basically what I wanted to show you. And yeah, this is a quite good strategy. It's a bit specific, only for it's specifically intended for protection and not so much for a return. But yeah, this is something that options allow you to do. It's not only for speculation, it's not only for investment purpose, it allows you to hedge, to protect against potential losses. And so yeah, this is all. Feel free to leave your comments and suggestions below, and also feel free to like the video and subscribe to the channel. I'm also available on LinkedIn in case you need to send me a private message and to have ask any question or make any sort of comment or suggestion. And so yeah, I'll see you all in the next one.